everyone, Bethany Clement, Elysian Properties.
Cody Touchette with the Touchette team at Caliber Home Loans.
And we realize it's been a little bit since we've given you guys a market update. And the sad, unfortunate truth is you just really can't believe everything that's on the media right now. And so we just wanted to give it to you straight. So what I'd love to do is first talk to buyers. There's good news for you buyers. The crazy, aggressive market has softened a little bit. Which just means that there's more listings coming on the market all the time. Every week, in fact, we're seeing more listings, which means things are a little less stressful, a little less scary, and you have more options. Even with the interest rates going up, there's some more availability for listings in your price point. And also, we're seeing a little bit less of the multiple offer or the escalated offer. And so that kind of gives you a little bit more peace in knowing that your deal is going to be accepted. We're seeing more of those deals accepted. The other thing I want to talk to is sellers. We are still in a seller's market, and that really just means that demand is still not quite, supply is not met demand. Buyers want to buy your home, and home prices are at an all-time high, and so you are getting top dollar for your home. So all of that is really good news for sellers. So what can you tell them about interest rates?
Yeah.
So how are things going that way?
Yeah. So on the whole, interest rates are continuing to climb. We're over the last 12 months, we're up about 1% from where we were a year ago. 1% rise in interest rates equals about a 10% rise in the payment. So if your payment on the house that you were looking at was going to be $2,000 a year ago, now you would factor that in about $2,200, right? So a pretty substantial increase.
That is substantial.
We are seeing rates continue to rise, although very recently with some of the trade war talks and some of the economic news that's happening around the world, we're starting to see some uncertainty. Uncertainty with regard to inflation is not a good thing. Mortgage-backed securities or bond traders don't like inflation. It makes their portfolios worth less, and so they raise interest rates if that happens. If they're not afraid of inflation, then we can see rates subside a little bit. With the stock market tumbling yesterday, that led to a little bit lower rates today. So a little bit of positive news there, and possibly giving a buying opportunity, a locking opportunity if you're in the market to lock in an interest rate. But yeah, as far as home prices go, we kind of see this on a regular basis around this time of year where there's a little bit of seasonality to it. When good weather starts to come, school's out, vacation time, there's a little bit of a lull. So as a buyer, this can be a great time to jump in and get your offer accepted on that house that might have had multiple offers 2 months ago and might have multiple offers 2 months from now. This can be a great opportunity.
Yeah, well, and I really think that both buyers and sellers recently kind of got hit with the interest rates going up. Because the sellers got hit because the buyers kind of panicked.
Yeah.
They went, oh, interest rates went up, and then they either stopped looking, stopped buying, or some of them just got a little bit more aggressive in their offers or offering less. And so I feel like both buyers and sellers recently have been kind of like, ah!
Yeah.
But that's kind of changing, and that it's that lull, like you're saying. We're going to come out of it eventually.
And we saw that when rates kind of hit that 5% mark, right? So a vanilla flavored, good, decent credit score, 30-year fixed mortgage, crested 5% about 2 months ago, and that's really when people started putting the brakes on.
It's so interesting because 5% is still really a low.
And that's what we have to remember is 5% historically in the history of 30-year fixed interest rates is pretty decent.
Yeah.
We've all been
compared to 2 years ago.
We've been spoiled by rates starting in the 3s, and then even in the 4s sound pretty good, and then you get to the higher levels of the 4s and people start to shrink back a little bit and recline and think, oh my gosh, and then when you have a rate that starts with a 5, you think the sky had fallen and things were over, right?
Well, if you've never bought a home, you've never known what it's like to buy with 18 or 12%.
Or if you bought 2 or 3 houses in the last 4 or 5 years or 10 years, ever since the market crashed, we've been talking about rates in the low 4s and high 3s, and it's been almost 10 years that we've not seen a rate in the 5s, and so this is a big hurdle that we're going to have to get over. And if you're a millennial buyer, you wouldn't even think of a 5% to start with your interest rate. So it's understandable.
So I have a huge question for you.
Yeah.
So everyone talks about, are we going to crash again? Are we ever going to see interest rates go south of 4 into the 3s, or even in a comfortable spot like mid-4s? Are we going to see that again?
That's a great question. Obviously, I don't have the answer. My thought there is that I think that our new norm is probably going to be in the 4.5 range to the 5.5 to 6% range for the foreseeable future, right? If some major event happens, something crazy happens like the housing collapse in 2006 and 7, then we could see that. But to get interest rates to that 3 anything took a lot of government intervention. They were pumping money into the markets. They were buying mortgage-backed securities. They were buying treasury bills. They were doing everything they could. They were lowering the Fed funds rate. They did everything they possibly could to push interest rates down, to make the cost of borrowing so low that businesses and consumers would actually go out and spend money, because that was a problem, right? People were hoarding cash and not spending money, and good idea not spending money if you're not making money, but even the people that were making money in that window of time were still not spending it. Everybody was very scared about what to do if they did have some money. So you push the cost of borrowing down, and it encourages people to go out and spend that money. So when we're facing inflation, like is coming back now, then we're seeing prices of things going up in value, right? Everything's getting a little bit more expensive. Houses, a lot more expensive. Cars, more expensive. Food, gas, all those. And we like to measure durable goods too, things you don't buy every day. Those things are becoming more and more expensive. That means we have some inflation. With inflation rising, that means that the Federal Reserve or the government is not going to let interest rates stay low, because low interest rates encourage more and more inflation, and you don't want to get to a point where you have hyperinflation, where a cost of a car doubles in a year, right? We wouldn't want that, right? So in order to keep inflation in check, they will raise the interest rates, and they've been raising the interest rates. There's some talk that they may be able to slow that down a little bit, maybe not raise on every Fed meeting, but that remains to be seen.
Well, and that's going to affect the home prices, because a lot of people say, okay, should I sell this year or next year? And obviously we have no crystal ball, and we do believe that home prices are going to increase, but they possibly won't increase at kind of the steep escalation we've seen, which is actually kind of a good thing for things to slow down a little and stabilize a little, because it's good for both buyers and sellers.
The pace we were at was not sustainable. Everybody knew it, and this shouldn't come as a surprise to anybody for real. When we're seeing 16, 18% growth in the real estate market,
that's crazy. And we've seen that for 3 years.
We have, in King County, it's been 3 to 4 years of those kind of levels. So it's not sustainable. It's not really fun as a buyer, right? I mean,
or even a seller. That's a little bit of a stress for them too. I mean,
most sellers tend to be buyers, right? So if you're going to sell something, usually you're going to go out and buy something.
And that's what I see often is the seller they can't buy it.
It's created a lot of gridlock in our market too, because if you're not confident that you can go out and buy a new home, you might not want to sell the one you have. And so we face that a lot with our clients right now too, talking about various creative ways to buy before they sell. Instead of doing that. But now, if this slows down a little bit, we may not have to do that near as much.
So I hope this answered a lot of questions for you guys about the market, where it's at. Obviously, if you have specific questions, reach out to Cody or myself. We'll post our contact information in the comments as we've done before, so that you can reach out to us directly, whatever way is most comfortable for you, because we'd really love to help you if you are considering it. Like Cody's saying, the new normal may be the 4.5 to the 5 and 6%. So if you're kind of on the fence about should I do it this year or next year, I really think that the answer is clear. Do it this year if you can.
If I'm wrong, buy now and refinance if they go back in the 3s.
Well, there you go.
Right? No, there's no harm there. But if we're right and they keep going up from 4.5 to 5 to 5.5 to 6, you'll be glad you got in while you could.
Absolutely. All right. Well, thank you guys so much for watching, and tune in next week. Thank you.
Thank you. Bye bye.